If you're running a small business or maybe even just a demanding side hustle, you know that feeling, that cold dread that hits when you realize you have to deal with the finances.
Oh, yeah.
It's that moment when your great idea slams right into the reality of bookkeeping.
It's a totally understandable anxiety. I mean,
Yeah.
you're looking at hundreds of transactions, all this jargon you don't know, and it's information overload. You feel like you're flying blind.
And that is exactly why we're here today. We are doing a deep dive into the one piece of software that really millions of small businesses run on, QuickBooks Online, QBO.
Right. And we're not just going to cover the click this button and that button
Yeah.
stuff. Our mission is to take you from just being a user of QBO.
To someone who actually gets it, who understands the logic running underneath it all.
Exactly. We're pulling back the curtain on that centuries-old accounting code, the 5 elements, the accounting equation, and yes, the dreaded debits and credits. We want to give you that shortcut to knowledge so you get QBO quickly, but more importantly, you get the confidence to fix things when they inevitably go a little sideways.
Yeah.
Okay, let's unpack this, starting with that very first step,
Yeah.
just picking the right plan.
Yeah, that's a huge hurdle. So QBO is made by Intuit. It's all cloud-based, works on Mac, PC, whatever. But the subscription you pick, it really boils down to two questions you have to ask yourself.
Okay, what are they?
How many people need access to the books, and do you sell physical stuff?
Right, so if you're all service-based like a consultant or freelancer, you can probably get away with the basic plans, like Simple Start. For sure. It does the basics tracking, income, expenses, mileage, invoicing, but the big catch is it's one user, only you. You can't delegate anything.
So if you want, say, your partner or a bookkeeper to log in, you have to upgrade.
Instantly. You have to jump to Essentials. It's around $54 a month, gives you 3 users, and it adds some key things like managing bills, multi-currency support, and time tracking.
But here's the big one. The real dividing line that forces most people to upgrade: inventory.
That's the one. If you sell physical goods, anything from handmade soaps to furniture, you just have to go to the Plus tier. There's no way around it.
Why is that so critical?
Because Plus, which is about $80 a month, it unlocks 2 non-negotiable features: integrated inventory tracking and tracking project profitability. Without those, you're just guessing at your cost of goods sold. You can't run a product business that way.
And then there's the advanced tier, but that's for when you're not really a small business anymore.
Exactly. Up to 25 users, batch invoicing, all the fancy analytics. It's a different league.
And payroll, we should mention payroll.
Oh, yeah. It's almost always an add-on. It's great. It automates taxes, direct deposit. But the sources made a really interesting point. It's not totally automatic.
What do you mean?
Well, like in a place like Nova Scotia, you still have to manually add in your workers' compensation details. The software helps a ton, but it doesn't replace you needing to know your local rules.
That's a great point. It shows that even with all this automation, you still have to be the one in charge. Here's where it gets really interesting. Actually making the software work for you. First time you log in, you see the dashboard.
Your home base. Yeah, like in their sample company, Craig's Design and Landscaping Services, it gives you that quick snapshot: invoices, bank balances, profit and loss.
And I like that little privacy button they have. If you're in a coffee shop, you can just click it and hide all the sensitive numbers.
A very smart feature. But before any of that works, you have to feed the beast.
Step one, the absolute first thing you have to do.
You have to securely link all your business bank accounts and credit cards. This is the lifeblood. QBO pulls in your transactions every single day. If you don't do this, the whole thing is pointless.
So once that data is flowing in, you navigate using that panel on the left: banking, sales, expenses, all that. But the main action button is that big new button at the top.
hmm The new button is for your day-to-day stuff. Creating an invoice, logging a receipt, entering a bill from a vendor. It's where you tell the system what happened.
And then the other key spot is the gear icon in the top right, your settings.
Right. Accountant settings is where you put in your company logo, name, all that basic stuff.
Mm-hmm.
Don't skip it. It makes your invoices look professional.
And there are some surprisingly powerful things buried in there. The source material pointed out one deep in the sales menu.
Oh, yeah. Under messages, you can add text to your invoices like, all overdue invoices are subject to 2% month interest. If you want to enforce late fees, you have to put that policy right there on the invoice.
Okay, last thing under the gear icon, the chart of accounts. This always felt a little intimidating. Why is this list so important?
Because it's the structural DNA of your entire financial system. It is the master list of every single bucket where your money can possibly come from or go to.
So if that list is a mess,
Every single report you run will be useless. Garbage in, garbage out. It's the blueprint.
and that's the perfect transition. Because QBO is friendly, but it's not magic. It's just a nice-looking layer on top of some really old accounting rules.
That is the biggest mistake people make. They think, oh, the software does it for me. I don't need to know the why.
But you do. Because when the software gives you an error, you can't fix it if you don't know the rules of the game.
Exactly. And the game starts with the 5 elements of accounting. Every single transaction you ever record will touch at least 2 of these 5 categories.
Okay, break them down for us.
All right. 1, assets.
Yeah.
Stuff the business owns. Cash, inventory, equipment.
Got it.
2, liabilities. What the business owes to other people. Loans, credit card debt. 3, equity. What the business owes to the owner, like your initial investment.
Okay, assets, liabilities, equity.
Then you have 4, income or revenue.
Yeah.
Money you earn. And 5, expenses. Cost of doing business. Rent, salaries, fuel.
And those first 3 are all tied together by the most important rule in all of bookkeeping.
The accounting equation.
Assets, liabilities, plus equity.
It must always balance. A equals L plus E. Always. Think of it this way. The business is its own legal person. Everything it owns, its assets, has to be claimed by someone. Either an outsider, that's a liability, or the owner, that's equity.
And the tool to keep that equation balanced all the time is double entry accounting. This is where debits and credits come in.
Precisely. Double entry just means every transaction hits at least 2 accounts. And the total value of your debits has to equal the total value of your credits. Always.
So, okay, let's get into this because this is the part that I think really confuses people. Debits and credits aren't just plus and minus.
No, they're not. At their simplest, debit just means left and credit means right, like on an old T-count ledger. But the key is the rule book for how they make accounts go up or down.
And the rulebook is based on the equation itself, right? A equals L plus E.
You got it. Assets are on the left side of that equal sign. So to make an asset go up, you use a debit, the left side entry.
Okay, that makes sense.
Liabilities and equity are on the right side. So to make them go up, you use a credit the right side entry. It's all about keeping the scale balanced.
So let's lay out the full rulebook for increasing an account.
Simple. You debit to increase assets and expenses.
And you credit to increase liabilities, equity, and revenue.
That's the whole game right there.
Wait, why do expenses act like assets? An expense isn't something you own.
That's a really sharp question. It's because expenses and revenue are temporary accounts. At the end of the year, they get rolled up into equity. Since an expense makes your equity go down and equity increases with a credit, the opposite action, a debit, is what you use for an expense. It all traces back to keeping AL plus E in balance.
Wow. Okay, that actually clicks. Let's try some examples. Say I'm Craig the landscaper, and I invest $27,000 of my own cash into the business bank account.
Okay, 2 things happened. The business's cash and asset went up, and your owner's investment and equity account went up.
So, to increase an asset, I debit. So debit cash for 27 grand.
Perfect. And to increase equity.
I credit. So credit owner's investment for 27 grand. Debits equal credits. The equation is balanced.
You've got it. That's a journal entry.
Okay, next one. I do a $500 landscaping job, but the client is going to pay me in 30 days. No cash yet.
Right. So accounts receivable, that's money people owe you, is an asset. That just went up. And your services revenue also went up.
So debit the asset, accounts receivable for 500, and credit the revenue account for 500.
Exactly right.
Oh.
See, it's just a set of rules.
This is what QBO is doing in the background every single time I click a button.
Every single time.
Yeah.
It's just hiding the debits and credits from you to make it easier. But knowing the logic is your superpower.
Which brings us back to the day-to-day work inside the software, the banking tab.
Yep. This is where the magic happens. QBO pulls in all those raw transactions from your bank, and your job is to give them a home.
And it tries to either match a transaction to something you already entered,
Right, like an invoice you sent out.
or it makes you add it as a new thing.
Exactly. So if you invoiced for $500 and QBO sees $500 come in, it'll suggest a match. You just click OK. But if it sees, say, a check you wrote that it doesn't recognize, it flags it as uncategorized.
And that's where you have to do the work. You have to tell it the vendor and pick the right category from your chart of accounts like fuel expense and then click add.
And that step is so critical because if you categorize it wrong, your reports will be wrong.
This is also where bank rules come in, right? To save time.
Oh, they're a lifesaver. If you're buying paper cups from the same supplier every week, You don't want to categorize that manually every single time.
So you make a rule.
You make a simple rule. If the bank data contains paper cups, you tell QBO to always assign that vendor and always categorize it as office supplies. You can even tell it to approve it automatically. It's huge for efficiency.
Now, what about vendors? QBO makes a distinction between an expense and a bill. What's the difference?
It's all about timing. You use the expense function if you've already paid for it. You used your debit card at the gas station. It's done.
And that's where you can use the app to snap a picture of the receipt.
Yeah, that feature's brilliant. Scans it right in, attaches it to the transaction. Perfect for audits.
But you use the bills function when you buy something, but you haven't paid yet. You got an invoice with 30-day terms.
Correct. Entering it as a bill gets it into your system so you know you owe that money. It's critical for managing your cash flow. And QBO can even read the PDF of the invoice you upload now to pull out the vendor name and the amount. It saves a ton of typing.
So all this work, connecting the bank, categorizing, making rules, entering bills, it all leads to the big payoff.
The reports. This is why you do all the work.
This is where you actually get to see how your business is doing.
Right. And the two most important reports map directly back to those 5 elements we talked about.
First up, the profit and loss report, or the income statement.
This shows your performance over a period of time. A month, a quarter, a year. It's your revenue minus your expenses. It tells you if you're making money.
And this is what you'd use to compare, say, this quarter to the same quarter last year, to see if you're growing.
Precisely. The second one is the balance sheet. This is different. It's a snapshot in time. A single day.
And it's the ultimate proof that your books are right.
It has to show that assets equal liabilities plus equity. If it doesn't balance, you have fundamental error somewhere in your records. It's your financial reality check.
And beyond those two big ones, you can get reports like expenses by vendor summary, which is great for seeing where your money is really going.
You might be shocked to find out how much you're spending with one supplier. It's an incredible tool for spotting where cash is, bleeding out. But again, these reports are only as good as the data you put in.
So what does this all mean? We've seen that QBO is this really elegant, user-friendly tool. It hides all the scary debits and credits. But the reason it works, the reason you can trust it, is that unbreakable code running underneath.
That's the takeaway. The system cannot function if total debits don't equal total credits. A must always equal L plus E. The software is the tool, but the 500-year-old principles are the law. And knowing that law is what makes you a confident bookkeeper, not just a frustrated user.
And to wrap this all up, let's go back to where we started. The structure, the chart of accounts. We said it's always organized in a specific order. Assets, liabilities, and equity first.
The balance sheet accounts.
Then revenues and expenses, the income statement accounts.
So here's the final provocative thought we want to leave you with. Why that order? Why did the people who invented this whole system centuries ago insist that the balance sheet accounts, which show your financial position at one moment, must come before the income statement accounts, which show your performance over time? Think about how that structural priority might influence how an auditor or even an investor approaches judging the true health and viability of a business. Something to mull on until our next deep dive.